Welcome everyone to today's guest lecture with James Church, who was here last year. He's going to do a slightly different format this year. You were not here last year, but I was here last year. You might have seen we have a recording online with him last year. This year is going to be slightly different, but basically James Church runs a company called Mascot, and he helps people with raising money. He's going to tell you himself about it. He's written a famous book, a bestseller, and he's going to tell you everything about that. So we over to James, who's going to tell us about how to get investors, how to attract them. Thank you.
Fantastic. Okay, lovely. Well, thanks for having me. I'm thrilled to be here. We'll start, before I go through slides and all that kind of thing, I want to start today by just kind of canvassing the room a little bit and just sort of finding out how much you know about equity investment. So, have you come across equity investment before? Your third year entrepreneur student, presumably you have, you understand it. We can, hands up, nods. Come on guys, this only works if you speak back. Raise hands, yeah, nods, yeah. So we all know about equity investment. Now, I'm happy to just sort of tailor the talk to make sure you get as much value from this as possible. So do you have anything coming into today's session where you feel like you want to know the answer? Do you have any areas where you're a bit confused, you don't really know how it works? Because look, I mean, there's no wrong question here, there's no silly question. I work with founders that have exited 2 or 3 businesses and they still don't understand how equity investment works properly. So there's no. It's a difficult process. It's not normally talked about on business courses. So you're lucky that this university is kind of giving you that insight. So is there anything in particular you want me to answer today? Yeah, in the back.
I would like to know a bit more about PE firms and the best valuation models for PE firms.
Valuation. I should take. Can you take notes on what these things are?
I tell you, we have a board. We will take here. 1 second. We have here the magic box with all the markers that you need. You have in different colors, and you can color code it.
I don't think I'll get that creative.
Color code it, exactly.
Valuation methods. As long as I can read it, that's fine. Anything else?
You have a nice section in the book, of course, about valuation methods.
Yes,
How to find investors and how to tailor them to like the right investor for you.
Yeah. Cool. What else? There's another question. That's the same question.
Same question.
Just in particular in PE firms, like what's the top 3 most important things to think of when looking at evaluating PE firms in particular?
Yeah. Okay. So sort of due diligence on the VC or PE fund. Okay. Cool. Anything else? Yeah.
Like, what do you have to, like, if you're a startup, what do you have to have ready before, like, starting looking for investors?
Cool. So investment prep. Glad you asked that one, because that's pretty much what all those slides are about.
You have the right slides.
Yeah. Cool. Yeah.
The different ways of getting investment, like a safe note versus it's a flat amount,
Oh yeah. Okay. Cool. So equity versus safe. Yeah, cool. We can talk about that. Are you all? How many of you are starting businesses in the UK? Hands up. Or how many are going to go start them somewhere else in the world?
Somewhere else.
Hands up for somewhere else in the world. I won't talk about SCIS. That's a UK thing. Cool. Anything else? Yeah.
Also about like pitch deck format, or like Sequoia Capital has like a format. Which like template would you recommend? Is that
template structure? Yeah. Obviously, I recommend my one. Anything else? We've got quite a list. We've only got an hour. Is that good? Let's cover those things. So, some of these things I'll try and weave in. That we're going to cover. That will cover. That will cover. I'll try and weave these things in if I remember. If not, we'll come to them at the end. So, quick intro to myself. I'm James Church, as was said. I'm the author of this book, Investable Entrepreneur. It's a bestseller. My claim to fame is on the day it launched, it outsold Jeff Bezos, Elon Musk, and Richard Branson on Amazon, which was pretty awesome. It hasn't done since though. So if you all want to leave and buy a copy, help me kind of hit those guys again. That would be awesome. But one day is enough for me to claim it. So as said, I run an investment readiness agency. It's called Robot Mascot. We basically help founders prepare for investment and pitch to investment. I've worked with more than 3,000 founders to date in supporting them raise investment from all over the world, whether that be the UK, Europe, Middle East, Asia, Africa, Australia. We've supported clients all over the world. When we follow the methodologies I'm going to talk about today and that I write about in my book, they become 40 times more likely to raise investment. They've raised more than 220 million to date in pre-seed and to sort of Series A rounds, and these are typically round sizes of 100 to 150k, all the way up to 40 million in funding. We've won a few awards for our approach along the way, Disruptor Company, Advisor of the Year, and so on. Now, the reason we do sessions like this, the reason that I do these talks, the reason I wrote the book, is because we want to see great ideas and innovation flourish. We get excited by ideas, the incredible, entrepreneurship is all about ideas, all about creating things, and me and my co-founder are creatives at heart. We come from brand and marketing backgrounds, and we noticed about 8 years ago that founders really struggled communicating their ideas to investors in a way that investors wanted to invest in them. And we knew from our own experience in brand and marketing and running communication campaigns for brands that we could use our skill set to help founders better communicate with investors. And that's what kind of led us on this journey. We pivoted our business from a brand and marketing agency into an investor communication agency, and we haven't looked back. We've become the leading pitch agency in the UK. We're trusted by global VC funds to work with their portfolio companies. Now look, raising investment isn't easy. I think a lot of people like to think that I've got a brilliant idea, people will bound to throw their money at me because my idea is so incredible. But the fact is about 1% of founders are successful in raising their first round of funding. Once you get to know how funding works and you understand the process, your success rate massively increases. About 48% of founders who raise their first fund go on to raise their second fund, or their second round. So it gets easier as it goes because you know the drill, you know what investors are looking for, you have that experience, and it also helps that you're slightly further along in the journey with your business as well, of course. But funding isn't easy, and only a small percentage of founders are good enough to secure funding. There was a brilliant post today I saw on the train down here actually that summed it up really for me. Founders love to talk about their idea, and investors want to look for two things really. They're looking for a brilliant business idea that can make them loads of money or have a huge impact on the world if it's kind of a sustainable impact objective, but they want to invest in a business that makes money, creates an impact, has a difference. But they also want to find a founder that can make that happen. We can all have brilliant business ideas. I'm sure you've all been in the bar with your mates and they've all come up with this spontaneous idea and gone, oh, someone should create a business out of this. We can all have business ideas and all of us are capable of executing that into a scalable and profitable business. So what investors are looking for when you raise your round of funding isn't how brilliant your idea is. They don't really care about ideas. What they care about is, are you the founder who can turn that idea into reality? Because there's probably 20 other founders with the same idea as you, but they're unable to execute it like you can, or at least that's what you would hope. So you need to position yourself and convince investors that you're the right founder to take this idea forward. And there was a great post, as I say, from an investor today that basically said exactly that, just listing all the things they look for in deciding whether or not to invest in a first-time founder, an early-stage founder. And none of that was about the business idea, none of it was about the product, none of it was about the features of that product. It was all about the execution strategy, the market opportunity, the potential financial performance, or having an understanding of how to manage cash flows. All the boring stuff of entrepreneurship, not the exciting, creative stuff where you love to talk about your product and your features. And that is the reason why only 1% succeed, because only 1% really are good at that. So these things are called the investment killers that I'm talking about, and there's two big killers to raising investment. The first is being able to communicate your business case in a way that makes investors want to invest. And the second is being able to find relevant investors to pitch to. two things that have come up on that list of questions that you have. So we're going to cover these two things today, because if you get them wrong, it's game over. You're not going to raise your round of funding. As I say, it's not all doom and gloom, because today we're going to look through the key strategies that are going to help you succeed in that. So the first thing we need to do is solve the first investment killer, and to do that we need to understand this, and that's that, as I say, great ideas don't raise investment, and investors speak a different language to founders. And that's the big problem here, is that investors are speaking in a different way about business than many founders are speaking about business. So investors, they love to focus their attention on risk, valuable assets, proof, implementation strategies around the business. Whereas entrepreneurs, they love to talk about all the amazing opportunities, the amount of income that could be generated from this idea, the huge possibilities in the future, all of the amazing ideas you have for new features and benefits. And none of that stuff cuts through, because you're not talking about risks, assets, proof, and implementation. And it's this that's putting up a massive barrier between investors and entrepreneurs, and it's this that means just 1% of founders are raising investment. Because when you talk about risk, investors want to understand risk. Opportunity just sounds scary. When you talk about, when investors want to hear about the underlying assets in the business, your income's pretty irrelevant. When investors want to understand proof, all of the possibilities just sound like long shots. And when investors want to understand your implementation strategy, the idea itself isn't actually that important. The idea is only as good as the execution. So who do investors back? Who are these 1% of founders that actually go on to successfully raise investment? Well, I call them investable entrepreneurs. That's the name of my book. And the reason my book is called Investable Entrepreneurs and not Investable Business or Investable Business Idea is because investors are backing founders. They're not backing ideas. They're backing the founder who can execute that idea. So it's all about you and your relationship with that investor at an early stage, and convincing them on your ability to make that idea a success. So fundamentally, investors are looking for three key things. They're looking for a founder who can demonstrate the following. First, that they're highly resourceful. They can get people to enroll into their vision. If you can pitch your vision really well and get people excited by what you do, you can gain capital, but you can also gain the best advisors to join your team. You can also get great talent to join you on your journey. You can open game-changing commercial partnerships. All of these things come to inspirational founders who can pitch their vision, get us excited about what they're building. So they're looking for that. They're also looking for a founder that understands the financial risks, not just the financial rewards. You know, how it's easy to create a spreadsheet with a load of zeros being added to revenue year on year and say, look, we can achieve huge growth. Look, if we get 1 million customers, here's how much revenue we can make. What we really want to understand is, how do you manage cash flow to make that happen? How much is it going to cost to generate the IP, the resources to actually sell to customers, and also to acquire those customers in the first place? How are you managing cash flow? That's what's really important. The financial risks involved, not the financial rewards. And then finally, understanding commercial success. They want to invest in a founder that has a roadmap from where you are now to where you want to be, and you have a clear executional plan, certainly in the short term, and then also thinking longer term. How are you going to get from where you are today to a point where I can get returns on my investment, to a point where this business has scaled up by 10x, 20x, 50x, so I can get my return. So to make this happen, you need three assets. I call them the critical fundraising assets, and this is the pitch preparation part, right? How to prepare for your investment round. You need a pitch, you need some projections, and you need a business plan, and that's going to help you articulate these three things. The pitch demonstrates you're highly resourceful. It's the first thing an investor is going to ask for. In that pitch, you're going to be dynamic, exciting, engage them in the vision, and give them hints and tips to suggest that you've got a really solid strategy for success, and there's a huge market opportunity to take advantage of. Your projections are going to show how you manage cash and how you understand customer acquisition costs and how much it's going to cost to achieve the growth of your ambition, not just the top line growth figures. And your plan is going to give the short-term plan for success to your next strategic milestone, which could be your next funding round or your break-even point. But what are you doing month to month for the next 12 to 24 months with the investment that you raise to make this move this business forward and increase its valuation? And then beyond that, what are you doing over the next 5 or 10 years to scale this business up to a point where we can get huge returns on our investment? So if you don't have these three things, you're not going to be ready to raise investment. So I call it the pitch ready journey. And you need to have a business plan for commercial success. You need to have a projections that showcases the financial risks as well as the rewards, and you need to have some pitch assets that demonstrate yourself to be highly resourceful. Now, I might bring up some other slides in a minute to answer some of these other questions around pitch deck structure, but we'll move on to the second investment killer, which is how to find investors. So investors are suckers for FOMO, right? They love to, they really don't want to miss out on the next big thing. So your job as a founder is to find as many interested investors as possible so you can play them off against each other. With more investors interested, they're each delivered reassurance from the fact that others are interested that this deal is the right choice. Especially if you're focusing on angel investors. PE funds slightly different, but certainly with angel investors, it's a lonely space. It's your own personal capital and wealth being made on a decision between you and a particular founder, and you have nothing else to go on apart from your own gut experience, your gut instinct and experience. Which is why so many angel investors join angel groups, so they can see what other investors think. But if you can say, we've got 3 or 4, 5, 10 investors interested in investing in our business, suddenly the angel investor feels more reassured that they're making the right choice. They're being part of a round that others see potentially. So we want to create FOMO. That's the key. When you're reaching out to investors, it's to create FOMO. So how do we do that? Well, the key thing we need to understand is that the average angel investor is seeing about 10 pitch decks a week, probably more these days actually. This slide probably needs updating, but it's around 10 pitch decks probably on average a week. Of those, about 1 is of interest, so they have 52 meetings a year with prospective investments, and the British Business Bank has calculated that the average angel investor makes just 2 investments a year. So they're seeing about 520 pitch decks. They're having 52 meetings and conversations and going through due diligence, and then they're making 2 investments a year. So that's a huge amount of noise out there. So many people trying to get their money and only a small amount to give. So you've got to really cut through. You've really got to make yourself stand out, and that's why that preparation I talked about is so important. Showing yourself to not only have the brilliant business idea, but also being the right entrepreneur to take it forward. So how do we find the right investors? So we need to follow this strategy. We need to create excess demand, and we can only do that by treating this like a marketing campaign. So I'm sure you've all covered marketing at some point in your degree, but we need to create a marketing funnel. This is no different to any other marketing campaign. The only difference is your product at this point is your shares, and your audience are potential investors. Right? That's the only difference. Otherwise, it's just like selling anything else. So just think about any other B2B sales process where you're selling a service, a consultancy service or something like that. It goes through a very similar process. So we need to create a funnel, we need to create demand, we need to load investors in at the very top of the funnel and expect them to work their way through key phases of a campaign to the point at which they're ready to invest. So you're going to do loads of outreach. You're going to have to talk to hundreds, if not thousands of potential investors. And founders are always really surprised as to how much outreach they need to do in order to be able to close their round. So it's always way more than you think. 10x whatever number you've got in your head, and you might just about get to the point of reaching out to enough and having enough potential conversations with investors. Then you have the first pitch, and you pitch to them. Either you send them your pitch via email and they look through it and invite you in for a meeting, or you are at a pitch event and you pitch to them, or you apply to a fund or an angel group and they invite you in to pitch. But you have that first pitch, and then if they like what they hear, if they feel like there's a good opportunity here and they like you as an individual and they believe you have what it takes, they'll book some second and third meetings. You'll go through a series of conversations. They'll start exploring your forecast in more detail, your business plan, the market opportunity, really starting to get to grips with whether or not you understand your business as well as it looks like when you pitch. And if they're still impressed, if they still feel that you have what it takes, then they might give you an expression of interest. They might say, you know what, I want to be part of this round. I'm either going to do the full amount or I'm going to be part of that round. Either way, I want in, and I'm formally expressing my interest. And then at that point, you're going to go through a legal process. You're going to go through more detailed due diligence, where they're going to check that you are legally allowed to operate in the country that you're setting up the business. They're going to be checking whether you have any past convictions for fraud or anything like that. So they'll be doing their due diligence, and you will be doing your due diligence on them. I'm going to start ticking these off. Where have we got that? House fine investors have done, investment prep done. So that's where you do your due diligence on them. You can do it obviously before you reach out to them as well, but you'll certainly want to do your due diligence on them before they close their activity.
Just a question particularly on how to find investors. Like you said, you want investment like events and stuff, but how do you like, if say I'm starting right now and I want to find an investor for something in healthcare, how would I specifically find investors for healthcare?
Yeah, I'll touch on that for sure. So the due diligence that you might do on investors, we have a list, there's an article on our blog, I think, with all the things you should ask, but you want to be making sure that one, they are able to offer value beyond capital, if that's what you want. Ideally you want a VC that can open doors, or a PE firm that can open doors and make things happen for you, so you want to quiz them on what they bring to the table other than money. You also probably want to get references, what other founders, and this goes for angel investors or VC or PE funds, you want to get references from other founders, because we've had some founders dodge a huge bullet by having an interested investor, and then they've contacted some of the founders that they're previously invested in, they said it's the worst decision we've ever made, they're an absolute nightmare. So you want to make sure you get other founders' experience of what it's like working and having that person involved in your business, or that company or firm involved in your business. You want to be checking that you align with their investment thesis, that you're what kind of share of the pie are you in terms of their capital. Are you a tiny little speck in a big fund, and they're kind of just you're kind of one of the 5% they gamble on, and they're not really convinced it's going to work, and you're actually quite a small fish in a big pond, and therefore not a big part of what they you're not going to get a huge amount of their time, or actually are you one of their key strategic investments for the year, and are you quite a sizable deal for that fund, and therefore they're going to pay you more attention and give you more support. Some of the VC funds we work with VC funds to help them create their pitch decks to go and raise their money. They have accelerators and incubators and those sorts of things that attach to their VC fund to help with their businesses. You want to check those sorts of things. And you want to check for conflict of interest. Now, a good investor will identify conflicts of interests to you, but you want to be checking their portfolio and going, is there a conflict of interest here? Is there the potential that they're only really getting to know me and going through this process because they want to see what we're up to so they can inform someone who's a competitor to us? So you want to make sure you're doing your due diligence on them. Once both parties are happy that this makes sense as a deal, you'll go through the process of closing, which will involve the legal paperwork of issuing shareholders agreements and all those sorts of things. So this is the process you're going to get to. There we go. There's an investor enthusiastically spraying and praying their pitch deck to anyone who'll listen. We don't want to be like this Rambo with our pitch deck and just throw it at anyone. We want to be more like this guy, this Rambo, where it's a laser-focused precision plan for targeting your most ideal prospects. So let's jump into that. This is what your outreach plan should look like. You want to do some investor targeting, you want to promote the opportunity to that target list, you want to capture as much interest from that target list as possible, and then you want to go through that process of converting the interest through second and third meetings. So let's look at investor targeting now, answering your question at the front there. So what we need to be doing when we're targeting investors is we need to be looking for people with these kinds of characteristics. They need to have experience in a similar industry, niche, or technology to you. You know, there's no point pitching your B2B healthcare business to someone with a track record in AI tech development, right? The two things don't match. Someone interested in healthcare probably doesn't understand large language models, right? So you need to make sure that you're pitching to the right industry, niche, and technology expert. You also ideally want to be targeting people who are known investors that have invested at a similar round size or stage of development to you. So if you are raising a pre-seed fund of 250,000 for an early stage app idea, there is no point going and pitching to a PE firm that typically deploys, I don't know, 60 million into a future business. Equally, if you're building something that requires huge amounts of funding, and one of the case studies in my book is about a guy who that brought together this incredible team to create this new sort of financial technology product, sort of before fintech was a thing. This was sort of back in the early to late 2000s, I think. And they raised the biggest seed round ever. It was in the UK. It was something like 80-something million. And they knew no VC fund, no angel investor could afford to put 80 million into their business. So they went and pitched to PE funds, a little bit outside of a PE's wheelhouse, but they knew exactly what that PE was looking for, and they crafted all of the funding materials to make sure it hit the PE funds with exactly what they wanted. It took them 3 years to raise the money, mind, because they were kind of really out there in terms of what's normal, but eventually they raised the capital and convinced the PE firms that this was worth investing 80 million in. They did end up wasting all of that money, I say. And, not their fault, it was the FCA's fault. The FCA just couldn't get their head around this new kind of type of thing. Fintech was so new, and it took them 2 years to sign off the FCA regulation, at which point they had to have the whole team employed doing nothing for 2 years, and they burnt through almost 80 million and had to go and fund again once they got the FCA. So everyone got paid for just sitting around, so it was quite nice for them, I suppose, not so great for the investor. But anyway, we digress. So you want to be you want to be making sure you're targeting people that invest at a similar round size and development stage to you. Do they invest 250k checks, $1 million checks? Do they invest at pre-revenue, post-revenue? Do they invest in a certain stage of IP development? Have they got a track record of that? And then finally, you want to research and make sure that all of these people that you're going to target are, certainly if they're angel investors and not kind of funds, industry leaders, exited founders, actually people who can call themselves angel investors. You want to make sure they're high net worth individuals and actually have some capital to deploy in businesses. Because obviously, someone on the average salary could be working in a similar industry, but it doesn't, and have expertise in your niche, but it doesn't make them a good investor. So you can be targeting investors, and these are people who would be an investment analyst at a fund or an angel investor, and their job title on LinkedIn, for example, would be an angel investor. Now, word of warning, angel investors who have a job title angel investor on their LinkedIn profile are professional angel investors, and they think and act more like funds. And funds tend to do huge levels of due diligence. They tend to invest at a later stage of development, post-revenue. And although the term angel investor was initially coined to be an investor that gives you that first check to sort of give you that first big break to get the idea off of the ground, a quote-unquote angel investor who has that as their job title is actually acting more as a later stage fund, like a sole trading fund. It's just them, but they think and act and invest in the same way and at the same stage of the life cycle as a fund, we tend to find. So if you're looking for that really early stage kind of pre-seed check, or your pre-revenue, pre-product, often it's the exited founders and the industry leaders, the CFOs, the CEOs of companies that are in a similar niche or industry or technology to you that are more likely to invest. Their job title on LinkedIn is CEO of this multi-million pound business, but they have a portfolio of investments that they use. So a good example of this would be a client of ours that raised capital from an executive of an oil company. They made lots of money in oil. They felt a bit guilty. Well, they started to feel a bit guilty about it because their kids were on at them about how they'd destroyed the planet because of their job. But we'd like your money, but stop destroying the planet. Thank you very much. So he felt a bit guilty. So he wanted to start building an investment portfolio privately of sustainable investments to try and make him feel less guilty. And one of our founders came across that guy, and he liked what they had to do, and they ended up investing. So they were not an angel investor, they were an industry leader, actually in a completely different industry and technology, but they had invested in similar technologies in the past, a similar niche in the past, and that was their reason for doing it. So you're trying to find these people, and they're not easy to find, but we are trying to find these people. I'm about to run out of battery, god damn it. Might have to pause there. Do we have a plug? Oh, I forgot to plug myself in. Do we have a plug around here? Right here. Pause, we can cut this out of the video, right? do a sort of magic
No, it makes
cutaway.
it makes it lively. It
Put on
makes
some
it real.
music, get some music
It
going
makes it
in,
real,
it's
don't
the
worry.
interlude. Oh no! Moving your table, man. How'd you go? Hang on, I'm trapping this down. There we go. Boom. Whew. Saved it. There we go.
There we go.
Cool. Yes, we're back. Now, where was I standing? So we can get a seamless cut on there. So these are the tactics for once you've got that target list in place, and you know who you're targeting, and we're talking hundreds of individuals, because we know that like with anything, when you're selling anything, there's a few things at play. You've got to hit the right people who want what you offer, and you need to hit them at the right time when they need it. So even if they're the right fit for you, they might have deployed all their capital for the year, and it's another 6 months before their new sort of tax year happens, and they've got more capital to deploy. So the timing might not be right, even if they want to invest. So there's so many things here to consider, which is why we need to kind of cast the net broadly, but while staying as focused as possible. So the ways to get meetings with investors, the tactics you can use, would first be warm introductions. So if you can get a warm introduction to anyone on your target list, hands down, that is the best thing you can do. Now the trouble is, the earlier you are in your career, the less likely you are to be able to have a network of people that can introduce you to the sorts of people you're looking for. However, you may have friends, family, and colleagues who can make some introductions who are better positioned to do so. A great tactic that I've seen, and I would not condone this in any way, is to change your job title on LinkedIn to angel investor, and then go and connect with a load of angel investors, and then change it back to founder again after they've all connected with you. Because they don't connect to founders, because founders just pitch to them all the time. So I do know someone who's done that, and I don't know if it helped him raise investment, but he did get loads of investor connections on LinkedIn. But I would not condone that. That's fraud, and you must not do it. So that's just a story that happened once. But anyway, warm introductions to angel investors or VC funds or investment analysts are gold. You're much more likely to get a meeting with an investor if you've been introduced by a third party. If you give yourself enough time to build your network, you can start connecting with people who know angel investors now, meeting them at certain business groups and networking events, connecting with them on LinkedIn, maybe even looking at the portfolio companies of the investors that you're targeting, and connect to the founders and tell them, tell them how awesome they are, make them feel good about themselves, and say, look, you're in a similar industry to me, we don't compete, but you're in a similar technology, you've got a similar kind of business model. You're a bit further ahead of me in the journey. I see you've successfully raised your seed funding round. I would love to pick your brains and find out how that process worked. Let me take you for lunch. I'd love to pick your brains and see what this whole sort of funding process was like for you. I'm really keen to learn. Now, this is probably the first time that founder has had someone look up to them. They're always looking up to others for inspiration, but it's probably the first time they've had someone look up to them, and they're almost certainly going to be flattered by that, and whether or not they meet you for lunch, that's kind of showing that you really value their time. They'll probably jump on a Zoom call with you for 30 minutes just to kind of sound you out and get some conversations. Then you can start building that relationship with those individuals, and then hey presto, you've got yourself a network of funded founders who can all introduce you to their investors when the time is right. So start thinking about working backwards from your investors and think, who can I connect with now who can introduce me to them later? And the earlier you do that and the more time you give yourself to build that network, the better. So hands down, that's the best thing you can do. Second best thing to do is to just send email outreach to investors. Start sending this list, find out their email address. There's loads of online tools for doing that. And then start sending them emails. Very, very short elevator pitch of what you're doing and what you're building, asking them for their insights and advice on a funding round. Attach your pitch deck, ask them for their feedback. Don't ask them for money if you can help it. Ask them for just a little bit of advice. There's a great saying in Silicon Valley, ask for money and get advice, ask for advice and get money. So start getting advice from people first, building that network of people who are engaged in you and your business, and then those people are likely to be your first investors. Now, if you're running out of time and you have to raise investment in the next 6 months, then you need to be a bit more harder and kind of say, we've got a funding round, here's our progress, this is where we're at, we're looking to raise funding, here's the deck. But if the more time you give yourself to build these relationships and ask for time and not money in the first instance, the more likely you are to actually succeed in raising funding. So it's all starting early, starting with preparation. Applications to funds and angel groups, if you can find the VC funds and the PE funds and the angel groups that match your criteria, they often list their criteria on their website. There's loads of resources on Google to help you find particular funds, and you can research them, see if you're the right fit, and you can do email outreach to their investment analysts, but you can also apply directly via their website. Take a two-pronged approach and try and get an introduction and a conversation with them. Bear in mind, as with angel investors, VC funds invest in 1 in every 150 deals they see on average. When we're doing these pitch decks for these VC funds, they often put their pipeline in their decks to their investors, and it's often like 100, 200 startups that they're scouting, and then they're filtering down, and they've maybe got 5 in due diligence, and they've maybe closed 3 deals. So we're talking like they observe a lot of startups to invest in just a handful in the same way angel investors do. So just bear in mind, just because you got a meeting with them doesn't mean you're anywhere near close to getting their money. There is a lot of battles ahead of you to fight off the other founders in the same position as you. And then the final thing that I've seen work regularly is leveraging your social media, leveraging your existing network, your LinkedIn, if you've got an existing business, your mailing list. But basically leveraging social media to kind of be proactive in saying, this is our progress with our business. We're going to be looking to raise funding in the next 6 months. Here's where we are now. Here's where we want to get to. And when we hit that milestone, we're looking to raise funding for our business. Again, starting early, letting people know what you're doing. Keep updating them regularly on progress to find out how you might raise, how you're going. Because investors love something called traction. You probably might have heard people talk about investors always wanting more traction. You'll pitch to an investor and they say, I love what you're doing, come back when you've got more traction. What they mean is, that's a really nice way of them saying, I don't believe you can make this happen. But they don't want to say that, so they say come back when you've got more traction. And that means come back when you've made a bit more progress, when you've got more users or more sales, or you've innovated a little bit more on the product, you've got more research, primary research from your focus groups and your testing of your product. Come back when you've got more traction. Like I said, that's them really saying, I don't believe you yet, I don't think you've got this, but prove me wrong. Come back when you've achieved something more, and then I might start to feel that you can actually make this happen. You are someone I can trust with my money. So the earlier you contact these people and start documenting your progress publicly on social media, one of the great ways I've seen this happen is by maybe doing a weekly vlog that you post onto LinkedIn saying, these are 3 things that we achieved really well with our business and we're super excited by this week. Here's 3 things that we screwed up and learned from, and here's what happened and here's what we learned, and here's 3 things we need right now. If anyone can make an introduction to X, or if anyone knows a really good developer in Y, please let me know, because we're looking to make moves in those areas. And what that does is it shows everyone in your network that 1, you're making progress, 2, you're only human and you're going to make some mistakes, but it's okay because you're dynamic and you learn from them. And 3, you're really good at being highly resourceful, making shit happen, because you're telling everyone what you need and you're opening connections and making stuff happen. So you're kind of telling everyone you're a really good entrepreneur to invest into. And they're going to observe your progress, or if you reach out to them in email and they click on your LinkedIn profile, they could see these last few weeks worth of videos and go, wow, this founder's on it. They're really making things happen, and they can see that. The other way of doing it is regular email updates to interested investors as you go through the process, but keeping them abreast and keeping people updated on what you're doing keeps them interested, keeps them engaged, and shows that you can make shit happen. And that's what they want. They want founders who can make shit happen. The other thing it does is your network now know you're building a startup, that you're raising investment, and you can then start posting and sending messages to people saying, look, we're going to be raising a funding round soon. Anyone who can make any introduction to these types of investors, I'd be really open to it. And what tends to happen to our founders when we work with them is they find hidden investors in their network, people that they've met 10 years ago that they had no idea invest in businesses, saying, actually, I'd be interested in having a conversation about this. People that they know who kind of say, oh, my cousin is an investment analyst at X fund. Why, wouldn't it be also, or maybe I can connect you. And we've had other founders take this offline. We had someone who goes to church regularly every Sunday. He'd been sitting next to the same bloke for 12 to 18 months, he said. And they'd just chatted about the weather and sport and that kind of thing sort of before and after the service. And after working with us, he had his pitch materials ready, he was ready to go, he was going through this outreach strategy with us. And he said, right, I'm just gonna bring this idea into the real world. And he said, yeah, it's been a great week, so excited. I've never told you before, but I'm building a startup. We're now ready to raise funding. We've just had our valuation and our pitch deck and everything done. We're super excited. It's been a really exciting week. And he went, no way. I'm part of an angel group locally. Let me invite you in to pitch to me and 10 other angels. This guy's been sitting next to you talking about the weather for 18 months is exactly the person he needs to connect with. So talk about what you're doing. Tell everyone and anyone, no matter how random you think they are, and you never know who they might be able to connect you with. Things that don't work that founders try, and you can do it, but they tend not to yield such great results, is connection requests on LinkedIn, unless you're pretending to be someone you're not. Because investors tend not to connect to founders because they know as soon as they do, the second message is, I'm raising some money, here's my pitch, and they get hundreds of those a day. There was an angel investor I was talking to the other day, and he was just saying that he's got to a point where he just now doesn't connect to anyone on LinkedIn. He will send the invitation and he just ignores every connection request because he gets 50 connection requests a day because his profile is 4 times exited entrepreneur, strategic advisor and angel investor, and everyone just wants to connect with him, and he can't keep up. Public databases and mailing lists, if you pay for them, they're pretty good. If they're free, they're going to be shit data. What tends to happen is someone will try and be helpful and say, here's the mailing list I used to raise 2 million for my startup. Comment I'm in and I'll send you the list. And that post goes viral and they get loads of followers and they're really happy. And you download the list, and within 24 hours, these poor investors that are on this list have received about 10,000 pitch decks into their inbox. They're hiding in a corner, head in hands, rocking back and forth, waiting for it all to blow over, and they've not read a single one of those emails, and they're hoping that their email address is saved. If not, they're going through a process of creating a new email address and telling everyone who they care about that they have to change their email because it's been leaked to these founders that keep sending them loads of unsolicited requests. So if you pay for the databases and the email addresses, they're not leaked, and they tend to yield decent results. If they're free ones, the chances you cutting through is unlikely. So be wary of public databases and mailing lists. Investment brokers tend not to work at an early stage. If you're raising tens of millions, then an investment broker could be a great way to go. They'll take a percentage of the round for making the introduction and hosting the meetings and dealing with the negotiations, but they tend to only work at 10 million round, 5 million rounds plus, because their business model doesn't work otherwise. Early stage investment takes the longest amount of time. They're also the lowest value round, so if you take their time spent versus their percentage of the round, they end up earning, and then I was quoted recently in OpenVC's report about this because I've been talking about it for years and they went and found the data to prove it. The average broker brokering a seed stage round was earning something like £50 an hour for their work. By the time they totted up all the time spent coaching the founder and putting the deal together, the average broker brokering a Series A round was earning something like £500 an hour. So if you're a broker and you have a network of investors, where are you going to spend most of your time? You're going to naturally gravitate towards the bigger rounds because you work less and you get paid more. So what tends to happen is brokers start, and there's a big gap in seed stage funding that I'm going to fill with my incredible brokerage, and within 6 to 12 months, they're going, I'm only working with Series A plus rounds now, sorry guys. So anyone who's saying they broker early stage deals is probably very new to the game and hasn't quite learned that lesson yet. And then finally, relying only on your network is a contradiction to this first, this point on the left-hand side there. But what I mean by that is use your network as part of a multi-channel strategy that we've talked about, all the ticks on the left. Don't just talk about, rely on your network only, because maybe you find 1 or 2 investors through that network. You've then got a market of 1. If one of those 2 is interested, then whatever deal terms they offer, you have to accept. You've not created FOMO. You can't say, I've got other investors who value me vastly different. If they want 50% equity, you've got that or nothing. If you've got other investors willing to come on at 20% equity, you can turn around and say, look, the deal's at 20%. Other investors have valued us in this ballpark, and you're way off. And if you want to be part of the round, you need to join the majority. And that gives you flexibility. That gives you some kind of authority in the negotiations. So look, here's what happens when you get the pitch stuff right. When you get the right pitch, and we'll very briefly try and find that pitch structure for you, but when you pitch in the right way and you have the right pitch, it's backed up by those financial projections I talked about, it's got a credible business case, here's what happens. So this is, the green line there is like a typical robot Mascot deck, where we've gone through this process, we've talked about the founders, they're communicating their idea correctly. It's about less than 18 slides, 50 to 100 words a slide. And you can see we get about 3 times the engagement per slide, if not way more on this middle. That's normally traction, that's sort of roundabout progress and traction. That's the bit they really love. So that's what we're looking at in terms of getting that communication right. And also the drop-off, right? About 6 times less drop-off. So 6 times as many investors are making it to the end of the deck when you outreach to the right people in the right way with assets like a pitch, projections and plan that actually makes sense to an investor. Don't talk about loads of features and benefits and all of those things, but actually talk about strategic business cases of how you're going to take this value proposition to market. And this is what happens. You get more engagement if you talk less. So the less information you give them, the more engagement you get, because they haven't got time. They're time poor. They want to get a quick understanding of the business model, and then they want to invite you in for a chat. And you get more people looking at all of the information that you're sharing if you keep it concise and articulate. So this is what happens. We're going to skip this stuff because I want to really talk about your. There we go. So I want to talk about these other points that you've made, and we've only got 10 minutes left. But take a photo of that screen if you want to. You can take a assessment on that link, pitchready.co.uk, to get a free assessment of your current investment readiness. Just answer 20 questions and it'll give you a full report on your investment readiness. And then after that, we'll give you a link so you can claim a copy of my book for free. We'll post it to you in the post to any UK address, or you can download a PDF, or you can also listen to an audio version on SoundCloud as well. So there's 3 options to consume it, but you get it for free if you take that quiz. There you go, and there's the book. So let me jump straight into. Oh, and by the way, we do all of this stuff. That's what we do. It's our services. Let me just bring up another slide just to talk to you about the.
Sorry, could I ask, what was the name of the book, the first slide?
It's called Investable Entrepreneur.
Investable.
Yeah. Does this have? It does. Cool. Let me. There we go. There's some investors looking at you pitch with a complete blank look on their face. So pitch structure. Yeah, that's what happens. The sort of zombie stare we call it when you pitch to an investor and nothing. Nothing communicates, nothing cuts through. They're just like, what is this? Why does this even need to exist? I don't really get what it is. So what we want to do is we need to use storytelling principles. We use something called the 5-act structure that we've developed, and I talk about it at length in my book. But just to give you a brief synopsis, this is how every story throughout history has been built. Using this, the ancient Greeks were the first to use a 5-act structure. Shakespeare used a 5-act structure. It has exposition, rising action, climax. That's when Romeo and Juliet killed each other, and then falling action, resolution, and that keeps us hooked. We have a great introduction. We then get excited, and the tension's building, and then this big climax happens, and we go, shit, what's going to happen next? And then we find out what happens next, and then we all feel very happy at the end of the day, and we feel content with the end of the story. So that's what happens in most storytelling. We've been told stories this way for hundreds of years, so we're brought up using this structure from every kid's book all the way through to the books you read today. The film have kind of adapted it to a 3-act structure, but really they've just combined 2 acts into one. So this is how we're told stories in film and TV and books. So we can use that same understanding of storytelling and structure to create an incredible pitch. So the first is the hook, then the essence, then the evidence, the plan, and the ask. And without going into a huge amount of detail, I talk about it in the book, they essentially form the same job as the typical kind of storytelling structure. So our hook is our big kind of, why do I need to look at this deck in the first place? Your vision beyond making money. Maybe drop in some key stats, things that you've achieved, not how big the market is, although that could be one of them, but not kind of third-party data. What would be much better is to say, we've surveyed this number of people and got this result, or we've tested our pilot on X and achieved Y, or we've already got X number of customers, users, and revenues. But the main thing, if you haven't got any of that, is the vision beyond making money. Get me excited about how this is going to change the world. Then you talk about the essence, the value proposition. In just a handful of slides, the problem you're solving, the solution to that problem, and who this is for in the market, and maybe why it needs to exist right now. Why is now a good time? What changes in legal or political or economic or socioeconomic changes have happened that makes now the perfect time for this thing to exist. Maybe the technology wasn't ready for this idea before. Maybe society has changed in a way that makes this idea more relevant than ever. But tell me very quickly what the value proposition is and why it needs to exist in the market. No lists of features. If we go back to that chart of time engaged on the slide, I can guarantee you the one that has all the exciting features that you're really excited about on your app, that's the one that's getting the least amount of time spent on it. So just a top level value proposition. Then the evidence. This is the thing, that big peak that we saw, which you'll recognise that in the last slide, that chart I showed you, where we saw the amount of time spent on slide. Doesn't it look crazy? Like it's like that. The amount of time, but we love to climax. We love to climb. So the evidence is where we deliver the killer blow. We say, this is how much progress we've made. This is what data we have, primary data that we have that makes our business something that's going to be successful. Here's all not secondary research, desk research, but primary progress. What have we done to date? What progress have we been on? What's our journey today? Then the plan, what's our journey for the future? How are we going to take this to market? What things do we need to build? What IP do we need to develop to make this a viable business case? What's our revenue model, our commercialization strategy? And then the ask, how much are you raising? What do the forecasts look like as a result of you raising that money? How much more capital might you need in the future? What valuation are you raising at? How much equity is this investor going to get? We start to talk about how much we're raising, what the impact that will have financially on the company, and how much equity they might be getting in return. And also you could talk about what the valuation of the company looks like in the future, not today, but also in the future. So if we look at industry EBITDA multiples or revenue multiples, if we apply that to our forecasts by year 5, we could potentially be worth X hundreds of millions of dollars, pounds, euros. So we are saying, this is how much we're valued at today, here's how much we're raising, you're going to get 15% equity, and in the future, if we execute this plan to perfection, here's how much it could be worth. So you're telling them what they could get, and that will deliver you an X return on investment. So hook, essence, evidence, plan, ask. This could be, my next slides, just going through it. So this could be a 5-slide pitch for a 30-second pitch event. It could be your elevator pitch, 1 sentence for each. Or it could be a 15 to 18 slide deck where you have a couple or 3 slides in each of those sections. You want to have multiple different versions of your pitch using this same structure so that you can get people hooked and engaged in what you're doing. So that, don't care what you download from anybody else, that's how it's done. Their pitch decks, you'll get so many different some people say you should lead with your team, but the team is only the lead if you have an incredible team. If I'm a co-founding team with Jeff Bezos, Elon Musk and Richard Branson, but despite the fights, I'd probably invest in those guys because they always make investors a shit ton of money, and if they've teamed up on something, it's going to be good. I put that in the hook. If I've exited 3 businesses and made investors loads of cash in the past, I'll put that in the hook. I'm sorry guys, if I'm a student at a uni with no business experience and barely any life experience, I probably would put it down here just to sort of tell them who I am. I'm not being rude, but it's not the hook. I'm not investing in you because I'm investing in your ability to become one of those people in the future based on everything you tell me here. So I would suggest most of you probably lead with the vision, but if you have some advisors on your team that have done the things that I just spoke about, then perhaps you do put the team to the hook and you say, here's me, but here's my advisory team or the people I have around me who have achieved all of this stuff. So you're kind of thinking about what hooks an investor and then telling them the idea. So that's the pitch structure. We've got 2 minutes. I'm definitely going to cover these things. Valuation methods. There are 3 types. When you're valuing a company, obviously it depends on what stage of development you are. So let's say you are pre-revenue, right? Your forecasts are highly unreliable. There's no data, there's just assumptions that they're built on. So we can only value your company based on industry data and analysis. So we'd use something called the scorecard method, and you can research these, or the checklist method. And basically, both of these 2 use a system basically breaking the company down into key things that investors care about. The strength of the team, the quality of the IP, or the potential future value of the IP, uniqueness of it. They would look at the size of the market opportunity. They would look at progress to date. So you'd break this company down, and then with one of them, I can't remember which one, but one of them takes an average valuation. It uses big data to say this is an average valuation for the company. So based on big data, companies like yours raising around at your stage of development are typically valued at X. How do you compare? So let's use that team as an example again. If I can score you out of 100, if you're a founder with no experience straight out of university, you may be quite low down that score, but if you're a founder straight out of university with a great team of advisors around you with huge lots of business experience guiding you, you're higher up on that score, and if you're Jeff Bezos, Elon Musk, Richard Branson, you're right at the top. So you score somewhere on that line, and based on that, we can figure out whether you're above or below average, and then you can calculate the valuation from there. The checklist does the same thing, but it does a maximum valuation. So it just kind of says the most a company of this business could achieve is this, and if you score 100 out of 100 on everything, you get the maximum, and anything less, you get the low. So it's a similar process, but it looks at average and max valuations on big data. So that's the best way for early stage startups. For later stage, you use something called discounted cash flow, which have 2 different versions, but it's basically using your forecasts, and it's kind of saying, well, based on your future valuation, based on the free cash flows available in your company based on your forecasts, we can discount that back to today's value based on various risk factors. And there's loads of them, but it's basically survival rates, so how likely are you to survive beyond this first, second, third, fourth, fifth year based on big data. Looking at current market rates, how much are people earning as a rate of return on the stock market and versus what they could achieve with you, and all of those sorts of things. And it discounts it back to today based on that. So you've got 2 versions where they calculate the terminal value differently. One is discounted cash flow with long-term growth. The other one is discounted cash flow with multiples. And the multiples one's pretty easy because it's like your future valuation is your profit or EBITDA times by your industry multiple. On average, businesses in my sector exit for 10 times their profit. So that's my future value, and we'll use that to discount it back today. Long-term growth just assumes that you continue to grow cash at a rate of X% indefinitely as you grow the business, and then it works it back from there. So they're the 2, but they're better suited for later stage methods. These give a lower valuation, these give a higher valuation. If a startup with a forecasts, no revenue, but forecasts to 30 million revenue and say we can achieve this, they'd end up with like a 20 million valuation using discounted cash flow. There's no way they're worth 20 million at a pre-revenue idea stage. So we have to use the right valuation method. And then the final one to look at is the VC method, which is the most simplest, which is basically, is most simplest the right grammar? Definitely not. It's the simplest one because it's basically saying that same kind of with multiples method from the discounted cash flow. It's saying in year 3 or in year 5 we plan to make X amount of profit, and providing you agree that our forecasts are kind of achievable and realistic, we can multiply that by the multiple and say in year 5 we would be worth, let's say, 200 million. Now you want to get a 50x return on your investment. So therefore, we need to divide that by 50, and that's how much we're worth today. That's how much you need to invest in us today to get the return you're looking for based on our growth trajectory, if you believe that that growth trajectory is the right trajectory. So that's the that's the one that we kind of say to investors, we're on your side. We're saying this is what you would need to invest us at to get the sort of returns you're looking for. So it's quite simple. So we would use all 5 of these and do a weighted average. And we would say, right, your early stage, so we're going to use 30% of that, 30% of that, 15% from that, and whatever's left over on these two. My maths isn't good enough. So you do a weighted average. Or your later stage, so we're going to use 30% of the discounted cash flow and only sort of 5% of these, because they're not really that relevant. So you can do a weighted average. And now you're going to an investor saying, I've not just put a finger in the air and said, I'm raising $1 million and I don't want to sell more than 10% of the company, so my valuation therefore has to be this. You're saying, I've looked at loads of different ways this could be valued, and we could be valued anything from 3 million to 20 million, depending on which method we use. And we've done a weighted average that brings us in, we think, realistically around 5 million. So much more kind of method to the madness, and makes it much more engaging. Now I realise we've gone way over.
You covered almost everything. You didn't cover the safe. Not the safe. Just one word about safe. What's the difference between equity and safe? 1 second.
So, very early stage startups might find that safe is a safe or an advanced subscription agreement, as we call them in the UK and ASA, is beneficial because it's basically a loan. It's kind of saying, here's money now, we're not going to worry about your valuation because you're far too early to really worry about it. It's all nonsense, it's all just made up shit at the end of the day. So let's not value you now. You need a few $100,000 to get off the ground, so I'm going to loan you that money and you're going to pay me back in equity at a future date. So when you then go and raise your $2 million round, that's going to be set at a proper valuation, and I'm going to get a discount on my shares. I'm going to get, whereas, I don't know, let's say investors buy them at $2 a share at that next round, you're going to get a discount and you're going to get your 200k that you loaned converted at a rate of 180. So you're going to get more shares for your money as a result of loaning you the money through a safe note today or an ASA today than doing straight equity. And it just saves that whole kind of having to value the company thing. So it's really popular in the US. And outside of the UK, not popular in the UK because we have something called SCIS, which is a tax scheme that gives high net worth individuals a huge benefit for investing in startup companies, and it's not compatible with a safe. So they don't do it. They use an ASA, but that has some complications, and that's not particularly popular either. So if it's in the UK, you tend to go straight equity. If we're outside the UK, safe for an early round is a really, really good option.
Thank you so much. I think we have come to the end. Thank you, come again. Thank you very much. We have the website, and you know where to get the pitch book and the book of. Thank you.